All right, let's get back to the markets this morning. David Burrows is the president and chief investment strategist at Barometer Capital Management, and he joins us in studio. Nice to see you.
Great to be here.
We mentioned earlier, slow day south of the border. They've got the U.S. Thanksgiving holiday, but doesn't change the fact that we saw record highs this week in the U.S. and record highs here in Canada. What's been your take on the market run?
So in January of this year, there was a very strong consensus view that economic data would slow through the year, a lot of concern around recession. We had seen a ton of volatility in the fourth quarter of last year, and there was a lot of fear in the market. And our view was that we had been through a correction in a bull market. Our view for several years now has been that we're in a secular bull market that will have interruptions. 2015-16 was a good correction. 2018 was a significant correction and a reset.
That sell-off we were seeing basically around this time last year.
That's right. Because positioning had become a little bit extreme on the bullish side, and that got worked out. Now, from January through kind of August, while people put money back to work, there's a ton of money that's hostage to the market, and they were not necessarily positioning for an upcycle, they were positioning to lose less. So we know that positioning in defensive assets, utilities, telcos, REITs, things that would generate income, became extremely overowned and very, very expensive. And over 18 months, people reduced their economic exposure substantially. Now, to me, the market signaling has been, we are not headed to recession, because over the last number of months, we've seen a great pickup in semiconductors, railroads, financials recently. These are not things that do well in a recession, but we're taking out absolute new highs and relative highs versus the market. So I think we're at the very early stages of a rotation where people start to say, maybe I need a little more economic exposure in my portfolio. So our view is January kicked off the beginning of what is likely 3 years of upside and repositioning, and that market really is signaling soft landing, not recession.
So really helpful context when you look at the breakdown of the best performing groups on the TSX this year. Like tech feeds into the story you're talking about. They're the best. That's a small group in this country. Utilities as a group are up more than 30%. Real estate is up more than 20%. And this is a big issue for a lot of investors who buy into those groups as safety plays. I mean, it's great if you're getting steady dividends, but after those rallies, I'm wondering how you feel about the stock performance going forward.
So this is a big issue, right? Because if you take the typical cycle, you know, a 3 or 4 year upcycle in the market, the things that have a correlation to a rising market are financials and industrials and technology. Things that have a very low correlation, which is why people hide in them, utilities, 20% correlated to a rising market. Staples, about 30% correlated to a rising market. So that's an issue, because if we are headed into an upcycle for the economy, those are not the sectors that participate. In the early 1950s, we got the last generational low in interest rates at about 1.6% in a 10-year bond. We think we saw a generational low in 2016 in the 10-year bond in the US. When rates started to rise in the 50s, over 16 years, rates went from like 1.6 to 6%. Staples and utilities gave almost no return because they were overowned and crowded. What did well was dividend growth and things that were a little more tightly tied to the economy. And what we're seeing since September is people recognizing maybe we're not going into recession, maybe we need a little more economic sensitivity, and maybe there's a good cycle in front of us, and cyclicals still are about as cheap as they've been since 1980.
So this is a big picture call you're making. A lot of times on a daily basis, though, we're talking about these smaller daily catalysts, like we talk about the trade story. Can they get a trade deal done or not? I mean, how much of that narrative fits into how you think about equity?
So look, over 18 months, we discounted a whole bunch of stuff into the market, right? Look at the way the market reacted to trade news 18 months ago. Look at the way it reacts to trade news today.
Kind of shrugging it off, you mean?
If the market isn't reacting to news, it tells you that people have time to think about it, they've positioned themselves accordingly, and it's in the market. So if you are defensive and bearish, even a small bit of good news is a positive catalyst. If you're positive and bullishly positioned, good news doesn't do you much good. So what we're seeing recently is small bits of good news feed into positive moves in the market. It tells you that positioning is changing for people.
All right, so just to recap, some of the areas you're cautious on, at least within stocks, would be groups like utilities and telcos and REITs. We're talking generally speaking here. It's an interesting year as well because we've got the TSX at all-time highs. We're basically up like 20% this year. But I can look through the benchmark and find all sorts of stocks that have underperformed. Some are energy names, big energy stocks like Encana and Husky. We've got this whole thing with the cannabis sector, right? Canopy is supposed to be seen as this sort of leader of the sector. It's been a terrible performer. You got BlackBerry, which has been, a down name as well. I mean, what should investors, given the thesis you're putting forward, if you're looking at these stocks, and this is that time of the year when people say, well, do I sell? Do I take a loss on this and use that to my advantage for any future capital gains I've got? Or if there is this continued bull market run, do I kind of just ride that out?
I think you have to pick your spots.
Okay.
So leadership in a new cycle tends to remain as leadership. What I would say is that when I look at the groups, financials, after a significant period of underperformance, I'm talking about globally, right, are taking out recent absolute and relative highs. That's important. Semiconductors making new absolute and relative highs, tightly tied to the economic cycle. Reacceleration shows up quickly in those names, especially the equipment companies. Industrials, railroads, same thing. Kansas City Southern just made a new all-time high, but broke out of a 5-year trading range. Now they do rail U.S. to Mexico. That's not very recessionary. You've got to follow the money. Now, cannabis is going through its own digestive period. I would wait to see something show up there. Energy does not seem to have a bid, and arguably fracking changed the game for supply demand in energy, and I think you got to wait to see something there. But these other groups are very clearly giving you signaling that people are looking beyond a weak patch in the economy to reacceleration. Now, PMI data globally has turned higher since July. Employment has stayed strong. You've got full employment in the U.S. going into a new cycle. There's going to be wage growth. Consumer strong. So you want to look for these groups.
Okay, and by the way, Kansas City Southern is KSU on the U.S. markets. Before you go, I just want to do the flip side of that. Say you've had a stock that's been a great performer. We mentioned a couple of times this morning that along with Shopify, Air Canada has been like a star, more than 90% this year. Now I look at what the average analyst target price is. It's still higher than where the stock is today, but it's had this huge move already. I mean, it sounds like based on the narrative that you're discussing here, you think a stock like Air Canada can keep rising even after a big 2019. Yeah.
So look at Air Canada trades at a discount to other airlines. They got a lot of great stuff going on. They're a catalyst in the business. The Aeroplan is going to add a bunch to their cash flow. New routes are adding. Pricing is firm. They've paid down, the vast majority of their debt, so they're becoming a much more sort of investment grade company, and this can go on for a while. It is cyclical. It is part of the industrials group, and I think that it's going to continue to be a leader in the market.
David, always good to get your take. Thanks for breaking it down for us.
Thanks for having me.
David Burrows is the president and chief investment strategist at Barometer Capital Management, joining us here in studio.